Walking around your city today, you wouldn't know it, but 1 in 5 companies you see is technically dead. They're called zombie companies, businesses that earn just enough money to keep the lights on, but not enough to pay the interest on their own debt. And right now, in the Russell 2000 index, the backbone of the American economy, nearly 40% of all companies are losing money. They are bleeding out. For a decade, they survived because interest rates were near zero. They borrowed cheap money to stay alive, but that era is over. In 2026, a massive $1.8 trillion wall of corporate debt is coming due, and they cannot pay it. When this wall breaks, it won't just bankrupt a few reckless CEOs, it will trigger a liquidation event that wipes out jobs, 401ks, and the value of your home. This is the forensic proof of the collapse that has already begun. The infection isn't random, it is systemic. Look at the Russell 2000. As of late 2025, over 42% of these companies were unprofitable. They are burning cash just to keep the lights on. This is the highest failure rate we have seen outside of a global recession. We aren't just talking about obscure penny stocks, we're talking about household names. Companies like Wayfair and JetBlue have been flagged as zombie candidates, burdened with billions in debt while their operating income struggles to cover the interest payments. They are running on fumes. Even Hollywood isn't safe. Lionsgate Studios, the giant behind John Wick, has faced severe pressure. Despite billions in revenue, the cost of servicing their debt pile is eating them alive. In the tech sector, the software debt bomb is ticking. Companies that lived on cheap venture capital in 2021 are now facing a reality where no one wants to lend them money. The growth at all costs model is dead. Now it's profit or die, and most of them are choosing to die. So how did we get here? Simple. We fell for the zero-interest trap. In 2020 and 2021, the Federal Reserve dropped rates to zero. Companies gorged on cheap loans. It was free money. But they forgot one crucial thing. Corporate debt is not a mortgage. It doesn't last for 30 years. It typically lasts for 5. That 5-year clock is hitting zero right now. A company that borrowed $100 million at 2% interest was paying $2 million a year. Manageable. But in 2026, they have to refinance that debt at 8%. Suddenly, their bill jumps to $8 million a year. Their profit didn't quadruple, but their interest bill did. That is the math of bankruptcy. But the zombies in the stock market are just the tip of the iceberg. The real danger is hidden in the buildings they occupy. Welcome to the commercial real estate crisis. Right now, developers are sitting on office towers that are half empty, but the bank still expects a mortgage payment based on the building being full. In 2026 alone, over $539 billion in commercial loans must be refinanced. Here's the trap. These loans were written when interest rates were 3%. To keep the building, the owner must get a new loan, but today the rate is 7% or 8%. The math is impossible. A building bringing in $1 million a year cannot pay a $2 million interest bill. So what happens? They walk away. We are already seeing skyscrapers in major cities selling for 50% off their previous value. This leaves the banks holding a bag of worthless assets. While everyone watches the banks, the real danger is in the shadows. It's called private credit. This is a $1.7 trillion unregulated market where private funds lend money to risky companies that regular banks won't touch. For years, this was seen as the golden ticket for investors, but cracks are forming. In 2026, major players like Blue Owl and Oaktree faced liquidity pressure, with some funds having to limit withdrawals. Imagine going to the ATM and seeing a sign that says, "You can only take out $20 today." That is effectively what is happening to billionaire investors. This sector is filled with what are called covenant-light loans. These are loans with almost no safety rules. Now the defaults are rising. These shadow banks are realizing they have no way to get their money back. If this sector freezes, the flow of cash to thousands of medium-sized U.S. businesses stops overnight. Finally, we have to look at the consumer. The canary in the coal mine is actually the telecom sector. In 2026, we are seeing a spike in bad debt for mobile carriers. Why does this matter? Because your phone bill is the last thing you stop paying. You stop paying for Netflix first. You stop paying for the gym. When people stop paying their phone bill, it means they are completely broke. We are entering a K-shaped economy. The rich are fine, but the bottom 50% are being crushed by inflation and debt. The savings buffer built up during the pandemic is gone. When the consumer stops spending, the retail zombies, the stores in your local mall, finally collapse. It's a feedback loop of destruction. The Fed has two choices: let 20% of the economy burn to reset the system, or print trillions of dollars to bail them out, triggering a second wave of hyperinflation. There is no third option. The era of easy money is dead. The companies that survive 2026 will be the ones with real assets and zero debt. But as an investor, where do you hide? History tells us that when the debt bubble bursts, three specific assets always outperform the stock market. In the next video, I'm going to break down those three safe haven assets and exactly when to buy them. You cannot afford to miss that. Click the button on your screen to subscribe, and I'll see you on the other side.